Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show, and I am Paul Winkler. We got pop filters here and everything. Wow. I'm just not used to being at the station. Yeah, we're actually at the station today. Evan and myself, Evan Barnard here, hanging out with me today.
Had to drag you downtown.
Do you have a pop filter on yours?
No.
Oh man, okay.
I have the
Watch
80s
those P's and S's, man. What do you
He's
think?
got the cover on it. It'll be fine. He's got the cover on it. It'll be fine.
It'll be all right. Yeah, that's right. That's right. I feel so fancy today. Yeah, so, oh my goodness, there is so much to talk about this week. I don't even know where to start, but that's never stopped me before. So how you doing, man?
I'm doing very well. Actually, a little bit sore from...
Sore?
I was stringing electric fence and doing some yard work and stuff like that out this morning before I did some show prep. So,
oh, gee.
I'm looking forward to sitting still for 2 hours.
The chickens?
Cindy takes care of the chickens.
Cindy takes care of the chicken. You're just going to be off the grid before we know it, aren't you? That's the way it's going to go. So, yeah, there is some good stuff to talk about. I have a lot of audios this week, and I think it's going to be educational, in that, some of these topics that came up this week, it's been, I don't know if there's ever a week that's not busy. Got some interesting conversations with just people that were outside the industry, outside, not clients, but people that actually just regular people, and got into some really interesting conversation regarding what they perceived investing was all about. And what is investing? And this couple ladies I got into this conversation with, and she said, "I got to read your book. I got to read your book about investing." And one of them said she had purchased a used copy, and I said, "I won't take that personally. You couldn't even pay full price for my book." No. Then another one found the old version of the book, Evan, Above the Maddening Crowd. That version.
Yeah.
And found that for $130 online.
Wow.
And I said, all right, somebody values it.
That's better than the S&P.
I know. It's not bad. That's some growth, right? So, that's funny. So we got into a conversation, and she said, I said, so what are you hoping to pick up? I just, want to know what to do. She likes the numbers, and I really want to get into the numbers. And I said, what are you hoping to find? And, which, like, for example, companies and things like that, how to figure out which companies I should be investing in. And I said, well, first of all, don't do that. And she goes, well, why? And I said, well, just think about this. What do you think the job of the investment manager is? What do you think their job is to help you with when it comes to investing? And she said, well, it's... help me figure out the companies. I just make sure that I stay out of companies. That's the way she said it. Make sure I stay out of companies that are going to go down in value.
Oh, wow.
And I said, okay, all right. So, find companies. So companies that are what? That they're getting ready to go down in value. Yeah, that's kind of it. I want to make sure that I avoid that. And I said, okay, that's fair enough.
That would make her normal.
That would make you normal. That's right. And then I said, okay, so what your assumption is that those companies aren't selling for the price that they ought to be selling for, that they're selling for less than they're selling for more than what they should be selling for. They're selling for a price that is significantly higher than what it's going to be once the news comes out that says, hey, it's a bad company. And the job of the investment manager is make sure that you avoid that. And she goes, well, yeah, that's kind of what I'm thinking. And I said, well, that would be something that you would think professional managers would be able to do. And guess what? And I told her the data on it.
Right.
And she's like, oh my gosh. And I said, yeah, you think about it. I said, we want to avoid what's called non-systematic risk. And I explained what that is. I said, imagine we were sitting in front of a large table. And I said, I want you to imagine that this large table is the ocean. And you've got thousands and thousands of boats on it. And I says, what's the likelihood that a couple of these boats could sink, or maybe a handful? She goes, yeah, I suppose it could. Yeah, a big storm comes along. Sure. Yeah, absolutely. And I said, what's the likelihood of all of them sinking? And well, no, that's not going to happen. And I said, okay, good deal. So in effect, what happens when we invest in all of these different types of companies, you're getting that risk off the table that you happen to have the select number of companies that sink, and that you end up in that situation where you lose everything. And that's where people historically have lost everything, is when they do that type of activity.
Yeah.
And that's the problem you run into. And I said, think of what companies want to do. They want to use your money. They want to pay you as little as they possibly can to use your money. You want to get paid as much as you possibly can. So you come to a price that is reasonable based on what you want, highest expected return, and what they want, lowest possible cost to use your money. And she's like, oh, well, that's kind of, and we just got into that conversation, and I got into a lot more in depth. And what was really cool is she walked away, and her friend, who was number phobic, walked away from the conversation because I hit it in a way that both of them would be okay with what they were hearing, and they wouldn't feel like they were overwhelmed. And they both walked away going, this is something you can grasp, isn't it? I said, welcome to the message for 25 years on the Investor Coaching Show.
Yes. Yeah. I mean, that is one of the most welcome conversations I have with clients, is somewhere down the line. I mean, it could be in an initial meeting, but usually it's, a few weeks into the relationship, maybe months, is the disinterested spouse.
Yeah.
Or the concerned spouse, whichever one. It could be the husband, could be the wife. Or, if it's, widow or divorced, just the individual makes the statement, wow, I understand this. That is just the most gratifying thing.
And it's critical
to me. And whether the account goes up or down, once you understand it, you've already won 90% of the battle.
And then you don't worry about it so much because it makes sense, and we fear that which we don't understand. Okay, so a bit of talk about our favorite subject, AI and GDP. Some conversation that was taking place on TV this week. So, check this out here.
What does this economy look like when you take out AI?
It looks much softer, but you have to be careful. We were just talking about
this. It's a crazy series of calculations.
The contribution of AI investment in GDP in the first quarter of this year was 1.5%
of the 2% growth.
3/4 of the 2% advance came from AI.
Information office equipment and intellectual property are both places where AI is showing up. But there's also a big import component of it that you subtract from it.
Yeah, when you think about GDP, you have to subtract imports, right? Because otherwise you're double counting what you're actually producing. And gross domestic product is actually growing at a 2% clip with a 1.5% contribution from AI, but 2 percentage points of imports in that. So net, we're probably a slight drag when it comes to AI.
I want to give you another number, which is...
Isn't that interesting?
Wow.
That I thought was so interesting, simply because we look at, okay, why is the economy doing well? Why is the economy doing fairly well? Some people would argue that it's not doing well, but you look at markets and say, well, why are stock markets? Let me go there first. Why are stock markets doing so well? Like last year, and we talk about international, Evan, how well international markets have done, especially the smaller companies, how well they did last year, the international small value set, which is something that most investors don't have in their portfolios, but up like 52%.
Yeah.
Why is it that area has done so well? Why are U.S. markets performing well? They did last year. So far this year, things are pretty decent. The stock market is a leading economic indicator. Okay, so we can look at it and say, well, the reason they've done well, even despite the Iran war, despite what's going on in Russia, Ukraine, it's done well because the stock market leads us into what is likely to happen in the future. And in effect, what we're looking at is productivity increases that may not be showing up necessarily in the data right now. So what's happening is the market's going up in anticipation that you're going to have these increases in productivity.
Yeah.
That's how the markets work. And we look at that and say, well, it's looking like it's going to be really great in the future. A lot of people complaining that the economy is not as good as they'd like it to be right now. And you have a lot of reasons for that, maybe housing issues and things like that. Another topic, why is housing going up so much? And, their lumber prices. And there's a lot of things that are playing into that. People blame interest rates, but you have a lot of different infrastructure input costs that have been expensive in that particular area. But let's go back to what he said, which is that if you include it, it's a drag on the economy. What on earth is he talking about there? Well, that tells you a little bit about maybe why the international has done so well. Because so much of what we're using for AI, chips, those types of things, is coming from outside the country. And this is a screaming the reason that we want to make sure that we want to have diversification all around the world, unlike what we typically see in most people's portfolios. All we typically see, Evan, if we see international at all, what do we see?
Large.
Yeah.
Every once in a while, I'll see a large emerging market fund as well and a choice, but that's about it.
Yeah. And if you look at what has been going on in the economy and the economic changes that have been taking place around the world, that is not the area that has benefited. It is not the group of companies, because you think about large international, what do you think about? You think about companies, the big car companies, the Nissans, the Toyotas, and the large companies that are producing, and you got the Taiwan Semiconductor and those types of things. But by and large, a lot of those companies that are producing some of these technologies that are coming in are smaller than that. So in effect, what happens is if we're not diversified across these other areas of the market, when these sea changes happen, you're not there. You don't have those benefits at your disposal. So I thought that was fascinating. When we look at how GDP, what is it? It's gross domestic product, for those of you who are wondering what on earth they're talking about right there. It's, the goods and services produced. And I was geeking out looking at, the formula and how it was affected. And it was interesting looking how they were actually making these calculations that they were talking about here. So then they were talking about the stocks and in the AI world. And this is an observation that was made regarding that.
Did you say on the call the other day that the average stock is down 15% from its high?
Yeah, the average S&P is like 13 maybe. That's not too abnormal, though, to have a lot of variation in the service. But what I do point to is equal-weighted consumer discretionary stocks in the S&P are 9% below their high. They have really lagged the overall index. So that suggests the market's noticing a lot of these trends.
So this is something we talk about an awful lot. We talk about the market's overvalued, right, Evan? I mean, that's what you hear that from. You hear that from people. It's overvalued. No, we don't agree that it's over. No, I wasn't saying that.
Be healed.
Let me be clear here. Because when you hear somebody say the market's overvalued, that means that we ought to get out because it's selling for higher than what it's worth.
Right.
And that is a market timing statement. We don't think about that, but we hear investment advisors, investment managers, we hear mutual fund company, representatives say that a lot. We think the market's overvalued. We think it's undervalued. And that is a sign that we need to do something different, that we need to change the investment portfolio mix. And this is something we've heard a lot recently, is that markets are quote unquote overvalued. Now, if you look at the S&P overall, which is just one segment of the market, you'll have small companies. It's a totally other segment, a totally different segment. Large value companies, totally different area. International, large, small value, and so on and so forth. Well, what we heard just there is that if you start to look at other companies, even within the S&P 500, which look at it, it looks like it's overvalued, quote unquote, based on historic averages. These companies haven't been doing so well. A lot of them haven't. And this is why when we talk about capitalization weighting in indexes, that this is problematic. When you have investment portfolios and funds, which is the way indexes are typically managed, which you're weighting based on the size of the companies, this is why you run into problems like that. you can look at the index and say, hey, the price is really, really high, which could cause it to come down. Well, why does it look high? It looks high because so much money is in just a select few companies.
Yeah.
And this is a reason that we want to make sure that we diversify into other areas that haven't really necessarily done well. And you think, well, why do I want to own things that haven't done as well recently? Well, it's because, what goes up comes down, and what goes down comes up. If we look at the market, sounds like a song.
Yeah.
But, that is why we make sure that we don't just put everything in one basket. Any other comments about that, Evan?
As you were going through that, what came to mind was, and this will be kind of a political comparison, but it's how, I think it's how humans and maybe Westerners in general struggle with math and percentages and things like that, is it's very easy to make a comment about 2 or 3 billionaires leaving New York City, and that's going to have a big gap in their tax revenue.
Yeah.
And that's big news.
Yeah, it is. Oh, I love where you're going with this.
And
Keep
yet,
going.
We've got 7 stocks that comprise, 30 or 35% maybe of the S&P. And if 2 of those go in the toilet, that's a big hit.
It is.
And so, but we don't think about it in those terms. When you hear this other example, you're like, oh, wow, I see that.
Yeah.
But it's the same exact principle.
Yeah. No, I love that. That's a good parallel right there that you're making right there. Because, you're right. We talk about it all the time, that if you raise taxes in a city that is really dependent upon wealthy people paying the tax revenue, the tax revenue coming from wealthy people, and they're paying the bills. When they leave, we go, oh my goodness, this is going to be terrible. And the Art Laffer, Rex Singfeld research is showing that every place that they raise taxes, revenue went down. Why? Because rich people are mobile. They get a house.
We're not stupid.
They're not stupid. Yeah, that's exactly right. And we don't think about it when it comes to investing. When you invest in portfolios that are weighted based on the size of the company, when those companies go down, it can have a huge impact. And that's why you've got to make sure you have better, spread the money more.
Right.
As I say in the book, I have that little cartoon. I can't remember where we got it. It says, investing is like manure. If you want to get good results, you got to spread it around.
Was that Mark Twain also?
I have no idea who said that, but it's good. You're listening to the Investor Coaching Show. Paul Winkler, Evan Barnard. We're going to take a quick break. Hey, just a note to you podcast folks. We just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, like dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on the Investor Coaching Show. Paul Winkler, Evan Barnard, hanging out here in the studio, actually in the studio at the radio station today, which is kind of fun to be here. Okay, so Evan, you go. What you got, man?
Yeah, this is just short little nugget out of Business Week or Bloomberg, and we hear a lot about it's hard to get hired for these new college graduates, and this is a tough job market and things like that. Mm-hmm. But there was an article on how to succeed in your very first job. And, I thought it kind of came at a good time, but it's interesting. They say it can be jarring to transition from college, where you learned how to succeed in a specific ecosystem, and exited at the top of the food chain to the working world, where you're back at zero.
Back at the bottom.
And so one of the points they made was being uncomfortable about that doesn't equal this thing called imposter syndrome. You're not faking being good at this new job.
Yeah.
And so the key is in embracing a beginner's mindset and taking advantage of just being new.
Well, they're stealing all that stuff from psychology. The beginner's mindset, imposter syndrome.
Right. So, it's your chance to be a sponge and all this kind of stuff.
Right.
But so here were some of the top points. Some of these are kind of almost self-evident, but you just don't hear it a lot. Show up on time.
Yeah, well, that wouldn't hurt. My dad said if you're not early, you're late.
Right.
See, like that. Okay.
Take notes in meetings.
Yeah.
Deliver an assignment when you say you will.
Or grab what I love these days, those of you who haven't messed with stuff like this, like Hynote, Hynote, you can actually record meetings and it'll give you summaries and bullet points, those types of things. Any kind of program like that. AI is great for that.
Well, yes. And I think part of what they were indicating, and I'm kind of reading into it at this point, is you're visibly taking notes so that your manager can see that you're interested and all this kind of stuff.
And it matters. Okay, that's a really good point.
But they both, it's great to have a backup because, when I take notes, I always miss something.
Sure. Yeah, okay, I got
most
you.
of the time. And don't let the boring stuff get overlooked. And, particularly once you finally, find your footing in a new job and you're like, okay, I understand this. I got this. It's not as exciting and it may seem boring, but that's still your job. That's still your responsibility. So,
and I would add, don't expect everything to always be fun and wonderful and meaningful. The reality of it is, sometimes you're doing stuff that you don't feel like doing.
I'm still folding the laundry in the afternoon. It's like, okay, well, whatever.
Well, you get paid for putting up with stuff that other people don't want to put up with.
Take in all the details from superficial things like what people are wearing to what the relationships are, because a lot of organizations are political. Pay attention to how the people you work with like to communicate. Now, I thought this was kind of interesting.
Yeah.
They were talking about
That's a really good point.
A junior partner was doing a PowerPoint presentation that just wasn't landing for a client. And this client prefers memos. And so he retooled the format and all that kind of stuff, repackaged the content, and then it was successful.
Well, it's interesting because let me make a comment about that.
Yeah.
One of the psychologists that actually does a lot of work with personality disorders, he refuses to use PowerPoints, and he says the research shows that retention is very, very low.
Yeah.
He said you have to interact with the presentation. If you're going to use PowerPoint, draw on it.
Yeah.
Literally draw on it, because you will actually pull people in by doing that, because they do not retain it because they're often in la-la land reading your PowerPoint presentation while you're talking. And you want to have that kind of interaction with them where they're watching you draw something out and it actually leads them through the presentation. So, and aside from those of you that do PowerPoint presentations, just heads up, they're not that great.
Yeah. One of the interesting ones was teach yourself to be a lightning fast learner. A decade ago, the advice was learn how to code. And now all these AI tools can partially do that for you.
Well, that's one of the areas where you're having job losses, in technology. Right. Yeah.
And so here's your advantage, because you grew up in the era of social media and things like that. There's a crop of college students who are as close to AI natives as we have. Becoming versed in the newest efficiency techniques can help you distinguish yourself and even put you in a position to educate those more senior than you.
Yeah.
And, if you're used to AI or, all that kind of stuff, I'm more than happy for James to come in and show me some little tool that can make my life better, right? Because that's the world that they live in.
Right.
And so don't be afraid to do that. And then it goes on to talk about cultivating just the traditional mentor in an organization to help you navigate that, and also cultivate a mentor outside of the organization that just has a different perspective on life and things like that. But, once you get that job, do everything you can to become indispensable to the business.
Yeah, keep growing. Yeah, that was one of the things I was really big on, is continuing to learn throughout entire work history, just continue to grow, because that's it. Things are changing. I always love what one of our friends makes a comment that he tries to reinvent himself every 5 years to make himself obsolete.
Yeah.
And I think that's really good advice. Continue to grow because the world will leave you behind otherwise. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.